Okay, good afternoon, everybody. We're going to get started. Welcome to the Catalyst Connection webinar series, and our series has been Strategic Ownership. Today we're going to be discussing our third in the series, our third topic, which is my business attractive to a buyer? Before we start the webinar, I do want to go over a couple of housekeeping items. Today's webinar will be recorded for future use. Please keep your phones on mute until the question and answer portion of the webinar. And during the webinar, you can type in a question at the top of the window where you see a chat option. You can type your question to that so that speaker can view it, and you can speak to it during the webinar, and we will have some Q&A at the end of the webinar. My name is Art Tintori. I'm Managing Director of Financial Services at Catalyst Connection, and our partner and our speakers today are Rivers Edge Alliance Group. And I want to introduce our first speaker, Todd Torquato.
Thanks, Art. I'd like to thank everyone from Catalyst for inviting us today and putting this webinar together. I hope everybody on the call here finds it helpful. I wanted to just start off by going through the agenda here. First off, if we've had a webinar series, and so this is the third in a series of 4. If you don't have a recording from the last session and you would like one, you can find one at Catalyst's website, mymanufacturingconnection.org. And you can find a copy there, or you could also email or call me directly, and I'll make sure that I can get you a copy of it, of any of the ones prior to this. We can go from there. But once again, I just wanted to say thanks for everybody taking time out of their day to be here today. We're going to go through just real quick the agenda that we're going to discuss today. So we're going to do a quick introduction of my firm, Rivers Edge Alliance Group. We're going to talk about some important stats and trends. We're going to talk about curb appeal for your business and the keys to enhancing the value of your business. We're also going to have a discussion about the most common deal killers that we see. And then we're going to do a quick recap, and then a quick question and answer session at the end. And just to reiterate what Art said, if you look at your screen on the right-hand side, there's a chat window there. If you could direct all your chat questions to Catalyst Connection so that we can see them here throughout the presentation, and then we'll collate all those questions and then answer them at the end of the presentation. So with that, I'd like to introduce you to my firm, Rivers Edge Alliance Group. We are a lower middle market investment bank headquartered in Pittsburgh, Pennsylvania. So we do mergers and acquisitions, business valuation, and strategic ownership planning. So what that means is we help people buy, sell, value, and enhance their companies. You can see my picture up there. I'm the co-founder and director here at Rivers Edge. And then with me, I have 2 of my team members, Cliff Brown, the Director of Valuation and Strategic Planning, and Jacqueline Ring, who's the transaction advisor and runs point on all of our deals. I'd like to first off talk a little bit about some important stats and trends. We always talk internally about the harsh realities of selling a business, and so the first point on here, 70% of all businesses are expected to change hands in the next 10 to 15 years, and the question really becomes: is your business ready to shine? And really the reason that that's of importance to you is that it's supply and demand. The more businesses that are on the market, the better yours is going to have to look to garner interest. And so what we want to talk about today is how we get that business ready to stand out from the rest that are on the market. We also know that it's estimated that up to 60% of all businesses that are put up for sale wind up not being sold for a variety of reasons. And now Jacqueline's going to talk about some of the, probably the top 3 deal killers that she sees, but there's obviously a few more and hurdles to jump through. Not only is it an emotional process, but it's one that takes a lot of preparation. And so, as you think about selling your business or transitioning your business, whatever that looks like, you can mitigate a lot of this by putting a proper plan in place. You can make it a much easier process for yourself, and you can maximize your outcome. 67% of business owners recently surveyed do not understand all their transition options. So we're going to talk a little bit about this in our next webinar, which is March 25th. But at a high level, you can transition to family members, you can transition to your employees, you can transition to a third party. And so we're going to talk about some of that today, but we're going to really dig into it at the next presentation. The other important fact is that 78% of business owners have no formal transition team of advisors. And so what we see all the time is that, it's not only us. It's not only us as an investment bank that needs to be at the table. You're also going to need an accountant, an attorney, and potentially a wealth manager as well. And everybody plays their role. Accountants are going to tell you how much of the purchase price you're going to keep. They're going to help you pay for the deal and make sure that your reps and warranties are proper. You have the right amount of coverage from a risk perspective, and the wealth manager will have an overall understanding of your financial portfolio and life to make sure that the proceeds of the business are enough for you to live the life that you want to live after you're done and after you transition. So those are the key people that are on there. There's some others too, but the key people are going to be your investment banker, your accountant, your attorney, and your wealth manager. One other stat that we've seen is that only 39% of owners recently feel their transition will be above average emotionally. And I can tell you from experience that transitioning to business is going to be an emotional experience, and with no plan, it's even worse. And Jacqueline can attest to that, I'm sure, every day. But the way to mitigate that stress is to have a plan in place and to be prepared. And so we're gonna talk about that today. We also see that we've also done some research, and 58% of owners expect to have some type of continuing role in the business after they exit. And this really comes back to the plan that you have in place. And Cliff is going to talk more about the vacation test and courageous. But the role that you have after post exit is really going to be dependent on the plan that you have in place. So whether you have to be there for 2 weeks, 2 months, or 2 years, it's all going to come down to how you prepare for that sale. So with that, I'm going to turn the presentation over to Cliff, and he's going to discuss ways to mitigate risk and maximize your return going forward. Cliff?
All right. Thank you very much, Todd. Thank you, everyone, for joining us today. I've enjoyed these last few weeks in terms of our lunch hour and sharing some information and stories that we have as far as what we have seen in the world of business transactions and how it might relate to your own personal situation. And just to recap briefly, our first webinar addressed the fundamental question that you as a business owner need to be asking yourself each and every day of your life, and that is, should I keep or sell my business? And the reason that we talk about it being a continuous question is that your situation evolves over time, both your business and your personal life. And things that you decided 2 years ago, 10 years ago, may or may not be relevant in today's world, and things do change. We have run across a number of business owners who thought they were going to do one thing with their business and ended up doing something very differently at the end of the day based on the reality on the ground and within their business. And it's important to evaluate that on an ongoing basis. Our last webinar, we talked about how to protect what is probably one of your most, if not the most, valuable assets, and that is the asset of your business, and how important it is that in the event of an untimed or unplanned exit, that very simple things are put into place that allow for your family, your management team to pick up the pieces and move on with the intentions that you had with respect to your business. We talked about how easy it would be to put together a simple protect your business file or what to do if binder that will be extremely helpful in a situation where you're not able to show up for work one day as it relates to simple things like passwords to your computer and keys to your file cabinets, etc. So today we're going to shift gears a little bit and talk more about a specific transition option, which is selling your business. And when we talk about selling a business, of course, the issue becomes one of attractiveness. Is your business attractive to someone sufficiently so that they would be interested in writing you the check? And there are a lot of different things that go into that decision-making process, but just to kick things off, let's talk about one of the very basic ones, and that is the curb appeal of your business. And I know most of us have either bought or sold a house in our lifetimes, and if you watch the shows on HGTV like I do occasionally about selling a house, curb appeal is very important, and by that I mean the very first impression that you leave your house when you're selling it is the impression that someone sees when they drive up for the very first time, and they take a view of your house, and it's a subconscious emotion that they experience, but within a matter of seconds they've decided whether or not that house is attractive and worth perhaps purchasing. Now, things can change someone's mind, but that first impression is lasting. And so I want to point that out in terms of how your business looks from an appearance standpoint as someone is driving up. Now, we all know that businesses of different types are in different locations. Manufacturing, for example, we don't expect anything out of the ordinary, but what my point here is that if you're in an industry that has a certain level of standard in terms of business appearance, that's what you want to shoot for, because I tell you that when a prospective buyer shows up to your business, they're going to sink in or take in the view of your business, how it looks from the outside, and make a determination as to whether or not that business has been cared for. And it's unfortunate, but real estate does matter in terms of how that evaluation takes place. Secondly, your reception area. And I can tell you that I've experienced a number of situations where I've walked into a business, either on my own or with a prospective buyer, and the reception area is not inviting. That can turn off a buyer almost instantly based on what happens once they walk through those front doors. Unfortunately, in many situations, it's not really been rehearsed, especially with businesses that don't have customers walking in the door every day, in terms of what happens when that prospective buyer comes through the doors and whether or not someone is actually there to greet them. So if I were to suggest one area that you could spend a very small amount of money and time on, it would be in sprucing up your reception or greeting area and making sure that your first contact people know what the game plan is and who's going to be greeting someone who comes through the front door, making sure that they do that in a very kind way. And
where was he? Okay. All right.
We're getting a lot of feedback on the line, and
I'd just like to remind people, please put your phone on mute. We're recording this webinar so everyone can hear. If you speak, if you don't put your phone on mute, thank you.
Thank you. Okay, so once we get beyond the reception area and making sure that you've got someone there who is able to meet and greet the right persons when they walk through the door, the next question is what's behind the curtain, and that is the door to the factory, the back room, or the warehouse. The opportunity to improve how your back area looks is sometimes daunting, but I know that a lot of us on any given day walk into our businesses, and there's a lot of stuff that we walk by every day and go, well, and you should probably take care of that or not take care of that. That is something that a prospective buyer is going to pick up on. They are going to see all of those messes. They're going to see how well organized your back area is. They're going to want to know how efficiently it's operating. Once again, all of that speaks to how this business is being run and how it is being cared for. And lastly there, remove what's not included in the sale. And I almost laugh when I see this, because there are a number of situations where business owners tend to use their business real estate to situate perhaps personal items, boats, additional cars, other things that might not store well at their house. That can cause a problem with a prospective buyer, only from the standpoint that if they see it and they like it, they might actually want it to be part of the business transaction. I'm not going to steal Jacqueline's thunder, but we just completed a transaction recently where a Harley-Davidson ended up being part of the deal, because I'm guessing that it was on site and it looked cool to the prospective buyer. So if you have anything on site that is yours and you don't plan on it going along with the sale of the business, I highly recommend that you get it out of there. One of the things that prospective buyers will look at, particularly in the manufacturing, is how operationally the back area is functioning. So the concepts of lean manufacturing and making sure that your shop floor is clean and what have you definitely have a lot of appeal when a prospective buyer is walking through. So reach out to resources that can help you in those areas and use them to your greatest extent to make sure that your business is looking well compared to what is going on within your own industry. And there's a lot of revolution happening in that these days. So it is something that is paid attention to. Okay, next. The most important thing is that you need to prove that the business isn't you. Jacqueline will talk a lot about this because I believe it is one of the primary deal killers. But when someone is buying a business, they're thinking into the future. They're thinking about that business from a investment standpoint, but they're also thinking about it from an operational standpoint. And they are wanting to purchase a business that is not reliant upon you as the current business owner for its continued success. Now, obviously, there is a transition period. A lot of business owners will remain on for a period of time throughout that transition, but a prospective buyer does not want to buy a business that 80% of the business relies upon a personal relationship that the prior owner had. So what I'll talk about now is what we call the vacation test. It's a very simple way that you can assess how important you are to your business on a day-to-day basis, and then hopefully begin to make some changes. And the vacation test is very simple, but it's going to be a little bit different than what you would normally do on a vacation. So let's take a vacation, but you need to commit to yourself that you're not going to check in with your office. You need to turn off your computer. You need to not turn it on and check your email. You need to keep your phone away from yourself in terms of calling into the business and checking your emails that way. What you want to do is have a period of time, ideally a week or longer, where you are not there and people cannot rely upon you to answer every single question that comes up throughout the day. And when customers call in, other people have to deal with the situations that you might otherwise have had to struggle with. And the purpose is this. You're going to get a very good assessment when you come back to the office of what's not going right in your company from an organizational structure standpoint. You're going to find that there are a lot of things that you should not be handling, quite honestly. So when you pull back into the office after your vacation is over, and I always refer to him as Anxious Andy, the one guy on your team that runs out to your car because there's 20 things that cannot wait the 5 minutes for you to get in the door for him to tell you about that has gone on during your absence. But it's more than just Anxious Andy. It's all the stuff that's piled up on your desk. And normally what happens with a business owner who has gone on vacation is they come back and they become the cat in the hat. They run around the business cleaning everything up at supersonic speed, taking care of all of the issues that have arisen, and trying to clean house, if you will. I'd recommend that you don't do that yet, because each of those things that have happened during your absence becomes your data set as far as what you can be doing to improve your lessened role within the business. And they really fall into three key areas. One is personnel, second is procedures, and the third is permission. And by sorting out all the stuff on your desk into those three categories, it will help you to create a plan to transform your business into a responsive enterprise even when you're not around as the backstop. So with personnel, you can start with your own folks and try to answer the following questions. Is it really necessary that this issue ended up on my desk? If it didn't, who can I refer this out to? Is there someone else within the organization that is capable and qualified to properly handle the issue? And would everyone else in the organization know that they could go to this person? That's very important. The accountability structure needs to be in place, and everyone needs to know who is accountable. And if no one else can handle the issue, could training get the right personnel qualified? With respect to procedures, we're talking about systems and procedures there. Could the issue have been solved with a simple policies and procedures manual if that were on everyone's desk? That has gone a long way in companies in terms of just having things memorialized and available so that someone can pull out the manual and figure out what needs to happen, as opposed to just running right to you like Anxious Andy would. Policies and procedures manuals usually involve a chain of command. Sometimes there would be cross-training of personnel, and there would be procedures that everyone knows and follows that can prevent everyone defaulting to you on most issues. And by the way, it's important to reinforce your policies and procedures manual by challenging in a positive way anyone who tries to sneak something through to you. And by doing that over time, you're going to instill in your personnel the fact that they can address the answers on their own. And lastly, with permissions, this may not be you, but most business owners do retain a tight control over their spending. In fact, I've come across owners of multi-million-dollar organizations that still require their sign-off on $50 expenses. Expenditure rules that can be put into place will give your employees flexibility to handle some of those unexpected expenses. And in fact, some go as far as to give each employee an annual budget from which they can work so that they don't have to be the ones making the decisions on day-to-day financial operations of the business. So that's what we talk about when we're talking about the vacation test, and it's a very good litmus test in terms of how well your business can run if you're not around, and that's going to be important as you move into a selling stage. Your management team, we talked a little bit about this in our last webinar, but making sure that you have a capable management team in place that can run the business without your participation is key. A prospective buyer is going to be looking at that, and in most cases, they're going to want those folks to stay around. So if you've got a management team that can be demonstrated as qualified and competent, that will go a long way in making your business look good relative to competition. And lastly, your emergency continuity plan, the one we talked about 2 weeks ago. Your emergency policies and procedures manual, whatever you want to call it, actually has lots of things in it that buyers look for. So you're doing yourself double duty by having that what to do if manual in place. Not only is it going to work for you in emergency situations, but all of the things that we talked about, your buy-sell agreements, among others, will prove to a buyer that your business is well structured and capable of functioning without you. So now we'll move a little into some of the meat of how someone would go about valuing your business. One of the things that I do a great deal of my time is value businesses. There are ways that we go about doing that have been around for 50 years plus. They're very regulatory driven in terms of the IRS and the courts, and there are certain rules that we follow, and that gives us what is called a fair market value. But is that really the value of your enterprise from a buyer's perspective? Sometimes it is, and sometimes it isn't. The interjecting force there is the concept of value drivers and what's driving the value within your business. And quite honestly, a lot of times those might not be picked up in a normal valuation. So to lead into that, I just want to share some key statistics with you. On average, companies have a 26% what we call value gap between the current value of their business and its potential value. 44% of that value gap can be fixed by improving the top 4 value drivers, and I'll talk about value drivers in a minute, but just keep in mind that a large majority of the value gap is actually contained within a small number of issues. Next, 73% of businesses have red flag threats that can and do kill deals during due diligence. These are things that buyers consider to be a no-go in terms of whether or not they're going to buy your business. And then lastly, nearly every private business owner, at least that I've met, does really not have a way to monitor and track the value of their business over time. This is not the New York Stock Exchange. How are you able to see what the value of your business is on a day-to-day or month-to-month basis? And is that business value improving? And we solve some of that in terms of our offerings at River's Edge, by the way. So now let's talk about value drivers. Value drivers 101. What are value drivers? One of the ways that I like to explain it is if you imagine a Rubik's Cube and all of the different colored sides of a Rubik's Cube, that's your business when you first set it up. It's all nicely organized. It's neat. You've got one color on each side, and it's elegant. But what happens over time is you run that business. The cube starts to move and be manipulated by you and by everyone else, your personnel, your customers, outside forces, internal forces, etc. So over time, your Rubik's Cube is getting more and more confusing in terms of how it appears. And if you imagine each of those blocks within a Rubik's Cube as a value driver, that's what I'm talking about. There are a number of value drivers within any organization. Most people put it between 50 and 60 different drivers of value within any given business. And if you can imagine the goal of value enhancement, the goal of evaluating your value drivers is simply to figure out a way to manipulate your Rubik's Cube business so that the colors can once again be realigned. By doing so, the profitability of your business goes up tremendously. To demonstrate that, I've got a graph here that might be a little bit hard to see on your screen, but this is how any type of business functions from a management decision standpoint all the way up to how value is created within the business. So if I can, yeah, there we go. So we start with the management decisions. Every decision that you make as a business owner and your management team fall into one of these four diamond categories: intangibles, your operating, your investment, and your financial. These decisions move up to what are called the value drivers that dictate the various aspects of your business. Growth rate, for example, within operating, your sales growth, your profit margin, your tax rate. Within your investment piece, your working capital and fixed capital, and then financial, your overall capital structure. As we all know, the value of your business is simply your income divided by your risk minus growth. And so that is determined by the cash flow from your operations, your cost of capital, and the cost of debt and equity. All of those ultimately flow through to create shareholder value. So that's it from a conceptual standpoint, but let's dig a little bit deeper into what value drivers are. Going back to my point a little bit ago about valuing businesses, there are ways in which a business can be valued that follow rules that have been around for 50 years. That is what is called fair market value. But we can go a little bit further than that. We can actually look at the value drivers in your business and come up with a value from a different standpoint altogether. And that is what we call the enterprise value. That's actually looking at how the value is being derived in your organization and how well it is being derived. And it's a completely different approach than a normal valuation. And I just have an example here of a business that we worked on last year in terms of the various value sets. So on the left-hand side, you have the fair market value that we determined to be the fair market value of the business. It came in at $3,130,000. Then following the different approach, using the value driver methodology, we determined that the enterprise value was actually fairly close, $3,120,000. That was a good sign for us. Most times you will see a differential there of at least 10%, and sometimes a lot more or a lot less, depending on what's going on within the individual company. But then we looked at a variety of different metrics within that business's industry to determine what the potential value of that business could be. And rather than the $3.13 million value, we were seeing a potential value in that business of $4.6 million, or in other words, a value gap of $1,510,000, as you see in that bar on the far right of your screen. The value gap is made up of the value drivers we've been talking about. And a lot of times that's where it gets left with business owners. You're told by someone, well, you've got potential value in your business. It could be improved by 5% or $1 million or what have you. But the question is, what do I do? What do I do with that information? How do I actually go about capturing that value within my organization? And the answer is this. The value drivers can be quantified very easily in today's technology environment. We're able to pull industry data and metrics to determine how well your business is performing in numerous different categories to determine where the value gap is. And we actually go as far as to quantify it in dollar amounts to make up that value gap of $1,510,000. So, for example, under operations, you'll see that there's a potential improvement of a little over $200,000, and that's made up of a variety of different things that have been identified within the organization. But what this does is it helps you to begin to assess within your own business where the issues might be, and also where the biggest bang for your buck is in terms of value improvement. So what we talked about earlier, 50% of your value gap is related to 4 or 5 of these drivers, and that really proves itself out in this assessment. So these are the areas that you might want to focus on first in terms of the largest improvement potential that exists within your business. Next, from that, a prioritized action plan can be developed. So within each of those value driver areas, there are specific tasks that we can look at that can be worked on and improved upon within the organization. And once again, using industry data and metrics, we can come up with a specific dollar amount within each of these action plan items. So at the end of the day, whether you're working with us or anyone else, you ought to have a plan in place that is specific and actionable, so that you can set up within your organization the change that needs to occur in order for your value improvement to occur. Hopefully, it's a fairly extensive list, and it has specific things that you can work on and check off over time. Oftentimes, what I will recommend is that you, along with some of your key team members, actually create a committee or whatever you want to call it that is in charge of this value initiative, so that you're holding yourselves internally accountable to making this value improvement occur. And by monitoring this on a monthly basis, you'll be able to see what your progress is and know that you're moving toward improving the value, toward that potential value that we talked about a little bit earlier. Okay, that is it from my end. And a lot of what I've talked about today is somewhat theoretical. There are a lot of things that come out of statistics and metrics that really don't have relevance in real-world situations, and so we wanted to be sure to address that as well. And so Jacqueline is going to talk about boots-on-the-ground situations that we have been involved with where businesses have run into issues with respect to what buyers are seeing. So with that, Jacqueline.
Cliff, and hello everyone. I am Jacqueline Ring, and as Todd mentioned in the beginning, I am a transaction advisor with Rivers Edge Alliance Group, and that means pretty much that I handle both our clients on the buy side and the sell side. So whether it's me going into a company with a client that's looking to buy the company, or it's on the other side where we're staging a company ready to be sold, I see a bunch of different deal killers that come across. However, there are 3 specific deal killers that come to mind here. So let's start here. What are deal killers? We consider anything that stops a deal from going through a deal killer. Like I mentioned, they can be emotional. There's a bunch of different deal killers, but like I said, there are 3 that pop out and we see most commonly. And then also, we'll talk about those in a little bit, but we'll also talk about how you can avoid these deal killers if you're looking to sell the company or if you're planning on selling the company in the future. So like I said, we're going to go through those, and then we'll figure out how you can overcome those if you're looking to sell your company. So first off, we're going to look at customer concentration. If I'm going in with a client to a company, the first question that we're going to ask is, how much percentage of sales does your top customer make up? And sometimes, I mean, that's a wide variety, but we're looking for a minimal amount. We're looking anywhere between 10 and 15%. You could say, hey, I have a customer of 50-plus years. He's very loyal, and he makes up a majority of our sales. And to you as a business owner, that might look like something special. It's 50%, or it's a large majority of your sales that you can actually count on. You know it's going to be there, and you know they're loyal to you. If they've been a customer of 50 years, you know they're coming back to you. However, it's opposite on the potential buyer side. They don't want to hear that. They want to hear that you have a smaller, your largest customer is a smaller percentage of the sale. They don't know the customer. They don't know how loyal they are. They don't know if they're going to be loyal to them when they take over the company. So this is one of the biggest things. Like I said, it's the first thing that we ask whenever we walk in there, and it weighs heavy on the valuation that we see. So if you're looking to sell your company, the best thing you can do is start working towards diversifying your customer base. Like I mentioned before, no customer should be larger than 15%. This really takes down the risk of the buyer and in turn increases your purchase price and increases your valuation from a buyer standpoint. The second one is operational dependency. I know Cliff touched on this quite a bit already, so I won't dig deep into this, but a buyer wants to see that a business can be run without the owner and his or her capabilities. I know in this space, in the middle market space, it's very hard for a business owner to kind of step back and let things be run without them. Like Cliff mentioned, the vacation test. I know that's very hard for somebody that has poured their blood, sweat, and tears into a company. But a buyer wants to see that a management team is set in place, and it proves that the business can succeed, not just because who the owner is and what they're able to do and accomplish and who they know. So once again, this just reduces the risk from the buyer's standpoint. So in this, like Cliff mentioned, the greatest thing you can do is do the vacation test. Figure out what needs worked on, who is coming to you with issues, who you need to put in place, who might be missing from the day-to-day operations. So if you reduce yourself from the day-to-day operations and the company runs perfectly fine, you know you've accomplished this, and this will not be a problem whenever you come down to selling your business. The third one is transition of customer relationships. I can argue that this is the most important transition that will happen during any transaction. If a customer relationship doesn't transfer, or if a few of them don't transfer, the business is not the same as it was when the owner was working. And once again, I know it's hard for business owners to kind of take a step back, but we've run across most companies, the owner actually handles all of the customer relationships. And if they don't handle all of them, they handle the big ones. So we need to make sure that those can be transferred with the sale. Our suggestion here would be to transfer them to employee A or employee B. And if employee A decides that he's ready to retire, he or she's ready to retire, then you transfer it to employee B or employee C. This proves to a buyer that, A, the relationships aren't just held with the owner because they're buddies of 20 years or they're the college roommates, and B, that it can be transferred to different people at different times, and then the company still survives. So those are the most common deal killers that we see day in and day out, whether it's on the buy side or the sell side. And if you're able to recognize these within your business and able to kind of work towards a solution with all of these, then you're going to be pretty well off whenever it comes to selling your company. So that's all I have here. Todd is going to do a recap of what we talked about today and then jump into any questions that anyone may have.
Thanks, Jacqueline. Thanks, Cliff, for the information here today. Just want to do a quick recap, and then we'll jump into questions. So to recap some of the main things we talked about in the presentation, first is that selling a business requires that the business stand out against its competition in the marketplace. Like I talked about early on, there's going to be an influx of businesses on the market over the next 10 to 15 years, and so it's important to make sure that yours is shiny and ready to go, that it's staged properly, and that can all happen with some forethought and a plan in place. It's also important to understand the current value of your business as well as the potential value through value enhancement. And so, when we talked about the team that needs to be there, we talked about a wealth manager, we talked about accountants and attorneys. I mean, you need to understand the value so that you understand what you're going to be able to take out from the business when you sell it. or transition it, and make sure that that's enough for you to live going forward the way that you want to. So it's important to understand what you're working with, first and foremost. As Jacqueline said, it's important to avoid the most common deal killers, to diversify your customer base, to remove yourself from day-to-day operations, like Cliff talked about with the vacation test, and transfer your customer relationships. We understand that, in a perfect world, it's easy for us to sit here on a webinar and tell you that, and that practicality, that all those things aren't going to happen right away. But if you have them in the back of your mind and you can start to transition and do those things, you'll be much better off when you're competing against others in the marketplace, because I can tell you that there's not a whole lot of folks that are giving credence to that or working towards resolving some of those issues. And the last thing on here is that the key to a successful transaction is reducing the risk for a potential acquirer. And so that's taking into account the value enhancements. It's taking into account and understanding the deal killers and trying to rectify those prior to taking your business to market. Doing all that and having a plan in place to transition the business will certainly mitigate the risk for the buyer. And what risk mitigation means to you is an increased purchase price at the end. So, with that, I know we have a couple questions that came in from the presentation, so we'll go through that. The first one here is about valuation and driver assessments, and Cliff, I'll give this one to you, but how long does it typically take to do a valuation, a fair market valuation that you talked about, and then how long does it take to do the driver assessment?
Okay, that's a good question. A lot of times the baseline valuation, as I'll call it, is really dependent upon the quality of records that we get, quite honestly. Mm-hmm. A lot of times we will get financial statements from a business owner that don't match up with the tax returns, and causes us to have to dig and discuss with the accountant the various differentials that we see. That can take time, just as well as just collecting the documents and getting them to us. But having said all of that, the process can be accomplished within 30 to 60 days. Would be the normal time range that I would see a traditional business valuation occurring once we get everything in hand. Some of those can go faster, but I like to say 30 to 60 days is the time frame on that piece. Now, with respect to the value enhancement, that's really a bolt-on or an add-on to that initial valuation, because a lot of the information that is gathered during that initial evaluation is used to then develop the enterprise value approach. So a lot of that work has already been done. There are some additional assessments and research that we have to do in order to put together that value driver report and come up with a prioritized action plan. But once again, that is also dependent upon availability of the business owner in terms of being able to answer the questions that we need to assess, as well as follow-up questions that we have. But once again, that's another 30 to 60 days, I would say, before we're able to come back and deliver that report. And then in terms of the accomplishment, which is the goal that everyone has, usually once someone has a value enhancement plan in place, we talk about a time frame of anywhere from 6 to 18 months to actually get everything implemented and working within the business so that value improvement can begin to be realized and seen from both our perspective as well as, more importantly, the buyer's perspective.
Okay, great. Thanks, Cliff. You answered the second question that came in already. The other question that came in is, understanding that customer concentration is a big issue. Can a deal still be done if the concentration is above 15%? And what does it mean to the business owner? So, Jacqueline, I'll let you take that one.
Absolutely. I mean, never say never. Anything can be done. However, if the customer concentration of their largest customer is more than 15%, it's actually going to add additional obstacles, elongate the due diligence process, and increase the risk for the buyer, which in turn lowers the purchase price. for example, in the past, we did a food manufacturing company, and I believe, if I remember correctly, their largest customer was about 80% of their revenue that came in. That did not deter the buyer. However, it did deter the bank. So it's not only that you have to convince the buyer to be okay with this, but it's also you have to convince the bank to do it and to complete the deal. So I'm not saying it can't be done, but like I said, it does equal a lower price in purchase price, as well as increase the risk, and sometimes that rate there in itself can be a deal killer for either side, either the sell side or the buy side.
Great, Jacqueline, thank you. Well, we took care of the questions that came in here during the presentation, so once again, I'd like to thank everybody for taking time out of their day to be with us here today. I'd like to invite you to the next webinar, which is March 25th. The title of that webinar is "What Does the End Look Like?" and we're going to be talking about transitioning out of your business, the different transition options, how long it takes, what it costs, things like that. So Jacqueline will be back on with the next webinar to talk about that, as well as Cliff and myself. So we look forward to seeing you, to hearing and talking to everybody again on the 25th, and I will touch base with everybody hopefully before then, and to get you a recording of today's webinar. So with that, I think we're all set. I look forward to talking to everybody on the 25th, and thanks again for being with us today. Have a good day.